Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Surgeon Syndicate. This is your host, Dr. Michael McManus. And today we're going to be talking about SEC regulations. The reason for this is I've had some discussions recently with people who wanted to know more about offerings or wanted to see details posted on the website. And they were people who came to us because of the podcast, because they saw blips about the podcast on social media and wanted to see what our offerings were directly, and then wondered why that wasn't posted publicly on the website. And so the reason for this is Security Exchange Commission, or the SEC, regulations that follow Rule 506B and 506C of Regulation D. And what these do is understanding the differences in specific requirements for the different type of investors and how much of the information about the investment can be made public and how much can involve what can be considered public solicitation or trying to recruit investors to the investment. So let's start with Rule 506B. If we look at general solicitation and advertising, under Rule 506B, issuers are prohibited from advertising or soliciting their offers publicly. This means they cannot use general media, social media, or public seminars to market the syndication. There are investor limitations. You can have both accredited and non-accredited investors. There's no limit to the number of accredited investors who can participate in a 506B. Non-accredited investors can participate, but there can only be 35 non-accredited but sophisticated investors. These sophisticated investors must have sufficient knowledge and experience in financial and business matters to evaluate the merits and risks of the investment. Disclosure requirements. While there are fewer formal disclosure requirements compared to registered offerings, it is still essential to provide enough information to especially non-accredited investors to ensure they understand the investment's risks and opportunities. The issuer obligations are that the issuer must have a pre-existing substantive relationship with the investors before any securities are offered, which helps ensure that the investment is suitable for the investor. And we'll come back to this a little bit more because this pre-existing substantive relationship is really the key thing here with 506B, and how it is that who are the people who can be given information about the investment. So Rule 506C, when we look at general solicitation and advertising, Rule 506C allows for general solicitation and advertising, meaning issuers can openly market their offerings through public channels, including the internet, social media, and public events. So any particular offering you see in a public forum that anybody can go there and see this information is likely a 506C. Investor limitations. For 506C, these are only open to accredited investors, and there's no limit to the number who can participate. There are verification requirements with a 506C. The issuer is required to take reasonable steps to verify that all investors are accredited. This could include viewing documentation such as tax returns, W-2s, bank statements, or obtaining written confirmations from a third party, i.e. a registered broker-dealer, an SEC-registered investment advisor, a licensed attorney, or a CPA. So what that's saying is some people get a little nervous about if they're doing business with a syndicator, sending them, their personal information about their net worth and their where their investments and all those things, such as tax returns. And that's where you can go to your CPA or to an attorney, or if you have a relationship with a broker dealer. But especially your CPA is one I've always used because they've already got all that information, and they can write you a letter that says, yes, you are an accredited investor. For a lot of the portals out there, that they will have a service they use that will generate a letter for you. And typically that letter is good for, I forget, 6 months to a year, and then it has to be redone. Disclosure requirements for a 506C, while formal disclosure requirements are still less stringent than for registered offerings, it is critical to provide investors with sufficient information to make informed decision. The focus on ensuring that solicitation and offering process adheres to the principles of fairness and transparency. So a big difference here is, as far as the two big things for me that always jump out about 506B and 506C is, one, 506B, you can have non-accredited investors, and 506B cannot be advertised or publicly displayed. So digging into that a little bit deeper, though, the key considerations between the two is your investor base. Again, if you have a network of sophisticated but non-accredited investors, this is a good choice because you already have the network of investors. The sophisticated part is basically saying that these people have enough experience to evaluate for risk, even if they don't have the net worth to be an accredited investor. So who this rules out is the working class, and maybe they're not even working class. Somebody who has only been employed, has never owned a job, has never owned a business, has not been substantially involved in the running of a business, and then they inherit a bunch of money and they want to invest it. This would be somebody who may have some money to invest and may meet your minimum requirements, but if the net worth is still below being accredited, and they don't have the experience, then they wouldn't be sophisticated, and they wouldn't be somebody who would come into a 506B. And again, these rules are put out there to try and protect people from getting swindled. So number two, beyond the investor base, number two is marketing strategy. This is, again, how it's going to be marketed. 506C can be publicly marketed, can be on a public website where if somebody logs into, with somebody, they don't even have to log in, they can look at your website and say, here's the deals we have. They're publicly available. To be publicly available, it needs to be 506C. Number three, the verification burden. 506C requires rigorous verification of accredited investor status, which can be more resource intensive. 506B does not have this requirement, making it simpler to bring investors on board. And so again, and then finally, the regulatory compliant. Both rules require adherence to anti-fraud provisions and federal securities laws. In either way, you have to maintain transparent and honest communication, and keep thorough records of all transactions. So if somebody's really wanting to promote something, they have to make it 506C, which requires a bit more paperwork and verification. But those can be made public for somebody to see. Now, if you're raising money for deals that are 506B, is more that you can say, hey, we have deals, but we need to develop a relationship before we can start to share those deals. So some of the things, practical steps and looking at the compliance stuff. And if you're a passive investor and you're on the investor side, some of these things you should expect comprehensive offering documents. And this is either way for 506B or 506C. This should include the private placement memorandum or PPM, subscription agreements, and investor questionnaires. And these should be, and you can see these in a couple ways. I like where there can be a short 2 to 6 page offering memorandum that gives you the basics. But then there should also be available a much more detailed deep dive for you to look into it. Building and maintaining relationships. This substantive pre-existing relationship is important. And we'll get into that here in just a second. So really digging into the deep dive of what really how much information can be made public with a 506B. Um, and this is the key and where these questions came up, like why is it so hard to get information on these deals? And that's because if a deal is 506B, there can be no general solicitation. The information about the offering cannot be made public in any form that constitutes a general solicitation. This includes not advertising in newspapers, on websites, which could be your own website, through social media or email or any campaign in a broad audience. Private communications. You can share detailed information about the investments only with potential investors. You have this pre-existing relationship and only as a private communication. And that's where often to get these communications, a syndicator will ask you to sign a non-disclosure agreement saying you're not going to share it with a broader audience. And a lot of time it isn't that this is something that's top secret. This is part of their regulatory burden saying they're not making it public. Because, if you really, everybody learned this, I think, in high school. If you want to make something public, you just share it with one person who is going to make it public, and you didn't make it public. They made it public. So there's part of this being private and where the non-disclosures come in. Targeted sharing. So for a 506B, it is permissible to share information in a more targeted manner, such as one-on-one meetings, private webinars, or communications with individuals who are already part of your investor group and have been confirmed to meet sophistication or accredited investor criteria. Disclosure to non-accredited investors, because in these you can have up to 35 non-accredited investors. With these, this is where really 506B, there is a little heavier burden on how much disclosure of the risks is made available and making sure they understand it. There's also, as far as investors, this part of the investor suitability of the requirement to make sure that the people in the investment are suitable for the investment. And the big part is this pre-existing relationship. Now, there's a lot of things that I can't tell you how many different stories I've heard about what constitutes this pre-existing substantive relationship under Rule 506B. And this is one of these things that gets into, and I'm not a lawyer, but in talking to lawyers, there is the letter of the law as it is written in the law. There is law that has been defined by court hearings that have interpreted the letter of the law. And then there are often what are just standard good practices within an industry. And a lot of these come into play if a deal goes bad and an investor is upset. So the whole point of this is making sure the investors understand what the deal is. And because this is a little less regulated and you can't market it, the whole idea is that you've got a network of investors and you've developed a relationship that allows you to offer them these different investment opportunities. So what are the key aspects of the pre-existing substantive relationship? Number one, these are going to be both the duration and the interaction, knowledge that the syndicator has of the investor, a qualitative assessment of the investor, documentation and record keeping of this relationship. It also involves methods of establishing the relationship, and there are prohibited practices. So let's go back through those again. So duration interaction, the relationship should have existed prior to the offering and prior to the investor knowing about the offering, that they should have already had meaningful interactions. This often means that the issuer and the investor have had several discussions or meetings where the investor's financial circumstances and investment goals are thoroughly discussed. And this is an important one we've talked about. When I talk to doctors, they're afraid of getting on a call with the syndicator because they don't want to be sold something. And they're so used to having people come into the office and pitch something and try and sell it to you. These initial conversations with most syndicators, one, they don't want to pitch something to you. Two, they're not allowed legally to pitch something to you. And really what they're trying to do is they want to learn about you and find out if it's a good fit for the both of you. And they are probably more concerned about this than most investors are, of making sure that the relationship is right and that they're understanding what you're trying to do. Example there, if somebody's retired and they're looking for cash flowing investment to live off the proceeds of the investment, is somebody who should be in one type of deal, or somebody else who is still making money and they're like, no, I just want to multiply my savings. It doesn't have to spit off any cash. They may make an investment, see no money out of an investment for a full term of 5 years or more before they see, on the sale of the investment, the turn. And so that's part of knowing that what the investor wants is part of what you're offering. So going into this a little more detail, is where the syndicator is required to have sufficient understanding of the investor's financial status. That's both how much money they have, whether these assets are liquid, how long they've been building this up, what their what their current income is that's adding to it, their level of sophistication and investment experience. Basically, do they understand how the business works within the real estate investment? Do they understand the business world of who you're renting properties to? What is their investment experience? Have they ever invested at all before? Or has their investment only been in managed funds, like a 401k? They just put money in the 401k, and somebody else out there does everything else with zero involvement. Have they invested in real estate before, only in the stock market? What types of things have they done? And the point of this is, do they understand this real estate investment? Do they have the ability to know what the risks and benefits are? And I've had conversations with people where you explain the risks and you can see that you're talking into the depths of the universe, that they're not getting it. And it's not that they can't understand, but if somebody's got a deep level of experience with a lot of different things in business and real estate and such, a 2-sentence explanation could be enough. And somebody else with no experience, they may need a 2-hour conversation or a series of conversations just to build up the knowledge level to where they can understand it. And then third is risk tolerance. We recently did a show talking a little bit about risk, and typically you see higher return with higher risk, lower return with lower risk. But understanding, the syndicator needs to understand with the investor where that investor's risk tolerance is, because if you put somebody with low risk tolerance in a higher risk investment, or in something that has some wild swings, you're not going to have a good relationship with that person. And as a syndicator, that's something I don't want. If I got something that's got a little bit of volatility and risk to it, I want people who are ready for that. And they're like, yeah, let's go do this. At the same time, if it's an investment that there's not a whole lot of moving parts and it's low risk and it churns off, decent returns, I don't want somebody who's high risk, high reward in that, because they're going to be like, what's wrong with this? I'm barely seeing anything going on here. What are you doing? So this is an important part of knowledge of the investor to determine if the investment is appropriate for that investor. Next, the qualitative assessment. The relationship should allow for qualitative assessment of the investor beyond just gathering financial data. This means understanding the investor's experience with similar investment, their overall investment strategy, and their understanding of risks, as we had just discussed. Documentation and record keeping. This is not just documentation of the project and records for it, but documentation and notes of the meetings they had with the investor. And that throughout time can kind of show the development of this relationship. So how do you develop this relationship? Easiest is if they've invested with you before, whether it's in partners, as a limited partner, an active partner, any such thing, that you have previous experience. That's pretty easy to show that that relationship is already ongoing. Business or social relationships. If you've known this person, if these are people you've worked with before, if you've worked with them in business and you understand a lot more about how that they then they understand from a business perspective, social relationships, also understanding of who this person is, risk tolerance, and what they're trying to accomplish. So that isn't the same level as previous investment, but it's still a much deeper level of relationship. Referrals. If investors were referred by existing investors, business associates, professional advisors, that provided the referral is more of a substantive vetting process, that this is coming from people who know your investments, know you, and that they also know this other person well and saying, I think this is a good fit. So that is, again, not as deep as a personal relationship already, but it shows it being on a deeper and more substantial level. An investor education series. So if the issuer holds educational events, now these need to be not specific to the current offering, but there are places where you provide education, and interaction at these events helps establish a relationship, and especially if these are followed up by further private discussions. And so what these investment events could be where it's a dinner and they sit down and teach you. It could be a webinar or a seminar, or things like a podcast. And that's part of the point of the podcast, is it gives a place for education to happen, so that even if it's not a personal interaction, the investor is learning from one of these different processes. And so then when you have personal discussions, which is the next step, and confirming, oh, they've been through this process with you. So they've developed a knowledge of you, they've developed a knowledge of real estate. And so then especially that initial call for the person offering the investment is really to get to know that investor. When I talk to somebody on the phone for the first time, I want to know about them, what drives them, what their why is for investing, where the money's coming from, that this is money they have available to invest, and it's not the money that if it's not panning out perfectly, they're going to lose their home. These are really the things that you want to go in that next step after the education series. And so really that's the process. So if you're doing 506B deals, when you start interacting with somebody, all of these things are taken into consideration as to whether the relationship is substantial. And to be substantial, the things that are required are all the things we've talked about here, but primarily that the person offering the investment understands the financial relationship, the motivation, and the risk tolerance of the investor, and that the investor understands the deals that they're going to be investing in to a reasonable degree, and that it fits within their risk tolerance. So things that are prohibited under a 506B, cold calling and mass emails, obviously these are considered marketing, or an immediate offering after an initial contact. So a relationship cannot be considered substantial if an offering is immediately presented on the first contact. There must be a reasonable period in which the relationship develops and the investor's suitability is assessed. So, this is a funny one, because when I talk to surgeons out there and they're like, I don't know about this. I've heard this story so many times. Like, I don't know about real estate. I'm kind of scared. Well, I'm learning some. And then they're like, okay, I understand enough. I trust you enough. I want to invest. Let's go. Who do I make the check out to? And it may be that, they did learning through other sources, other people, other places, and then they meet you and they decide that they like you and they trust you, and they're ready to jump in with both feet immediately, and they get frustrated. Like, tell me about your deal. Or you meet at a conference. Well, tell me about the deal you have right now. And that's what's prohibited right there. It's an immediate offering, and it can be hard to it's an education process. Like, well, guess what? If I have an active deal and we just met, I can't offer it to you after an initial contact, because what that's saying is, one, there needs to be a cooling off period that kind of shows I didn't push a hard sale there. but also that through that second process, the investor is still in the same place wanting to invest. And that this is now a relationship. It's not a one-off meeting. It's like, did you go on one date, or have you guys been dating for a while? What do you consider a relationship? So there aren't really hard and fast rules here is the interesting thing. And there are some different guidelines within the SEC. If somebody out there is looking to raise capital, my suggestion is make sure you get good legal counsel on how deep these relationships need to be if you don't understand it yourself. And I've heard different people talk about, well, it's a minimum. The number I've heard is 3 interactions. The SEC does not define a quantitative number of interactions to make it a predefined substantial relationship, because the focus is not on quantity of interactions, but on quality and substance of the relationship, which should enable the issuer to reasonably ascertain the investor's financial sophistication, investment experience, and suitability for this specific offering. So again, key considerations in establishing a substantive relationship is the quality of the interaction, meaning there should be meaningful and focused understanding of the investor's financial situation, investment goals, experience, risk tolerance. This includes discussing the investor's previous investments, financial status, their understanding of the risks, and their investment goals, their why for investing. What are they trying to accomplish with this? And that the process has been well documented. And while this is not explicitly required, just in developing the relationship, there should be documentation of what you talked about. And coming back, the time frame should develop over a reasonable period and not immediately prior to the offering. The SEC looks for evidence that the relationship was not solely created for the purpose of selling securities or selling this specific security, and an assessment of the investor's knowledge base. So again, for somebody who's new to investing passively in syndications, this is the reason why syndicators want to get you on a call and have a discussion with you. And there's always hey, book a call. What they're not doing is trying to book a call so they can make a sale. What they're trying to do is book a call to begin a relationship. They're asking you out on a real estate date. And think of this as like, this is a slow brew date. That this is not they're not trying to ask you on a date and develop something fast and furious. This is more of a like, let's have coffee and learn about each other, is what that first phone call is. Usually for most syndicators, this first phone call will be 15 to 20 minutes, and they'll have multiple calls booked. So if you're worried about them getting you on the phone and not letting you off the phone, most of the time that's not going to happen. They're going to be like, hey, great to meet you. Here's what we're going to do. They're going to lay out this process. I've got another call starting at X time. So we're going to wrap up 3 to 5 minutes before that. So I have time to get ready for my next call. And then they're going to jump right into it, wanting to learn about you. And if they're talking about them, they're not going to talk about a deal. They're going to talk about their how they operate their deals, what their overall beliefs are, what they're trying to do. If they're a developer versus if they're doing deals that are stabilized, if they're doing big value add, is kind of their overall perspective. So that's the whole point of let's book a call. And a lot of the time, the work of let's book a call is going in when there may not actually be an active deal, because by the time they have a deal, they want to have a relationship now where they could say, I think this is a good deal to you. And now I can pitch it to you and see if you think it's a good deal and answer your questions, rather than being this all at once. So this isn't really meant to be speed dating and then dive into a deep relationship. This is meant to be have coffee, get to know you, develop a relationship. And so that's really the point of the 506B world. Ones where you see out there where there's no discussion, if you can go online, look at the information online, go, yep, I want to do this, transfer money, that's a 506C. And it's a very different setup. So I hope that helps, especially for people who are just getting started in the passive investing realm. And they keep having people want to book a call. This is not a sales call. This is a first date call. So if you have any questions, reach out. I'd be happy to answer those questions. I hope this has been of value to you and help move your investment journey along. As always, thank you for joining us today on Surgeon Syndicate, and we hope to see you next time.
This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.